Let's bring in Jason Katz, who, by the way, I believe was just named a top 10 advisor on Forbes' list. So we're very lucky to have you here, Jason, sharing your wisdom with us. So thank you. I'm going to get to the Fed first. It says it's going to be aggressive, take no prisoners. So when do they finally slow down? I guess a better question is, can they provide a soft landing given the hawkishness of Mr. Powell?
Well, first of all, thank you, Ash. Second of all, It was a take no prisoners speech. Let's make no bones about it. And we have we have a bond market that got the memo, but a stock market that apparently didn't. And what was absent from the speech that no one's really discussing was any discussion of a soft landing. What was a surprise to most investors really was the fact that the higher for longer mantra is going to continue on. So to answer your question, the runway for a soft landing clearly is shorter now, and the fleet of rate hikes and quantitative tightening have gotten longer. So this is going to be an incredibly difficult needle to thread.
It really is. With that in mind, as someone who advises on stocks and tries to, navigate this, what are you telling investors? What are you looking at in this very, very uncertain landscape?
I know I painted a draconian picture, and the hits keep on rolling here Monday after Friday's losses. But look, not all recessions are created equal. And if we're going to have a recession, it's going to be Fed-induced. It's not going to be a function of an economy that's in pretty good shape right now in terms of bank balance sheets, corporate balance sheets, unemployment as low as it is. So I think the silver lining in the gray cloud is we are at peak hawkishness. We are at peak inflation. You look at some of the inflation readings, they're coming down. The Michigan sentiment survey shows consumers expecting inflation to moderate. Inflation break-even rates on Treasury inflation protection securities have moderated. Input costs, whether it be corn, wheat, lumber, or used car prices are coming down. So my point is, I think we're at peak negativity. And as a result, yes, we're going to have more volatility. And yes, we're probably going a bit lower. But we're not probably going to retest those new lows in our humble opinion. I think once we get towards the midterm elections, we should see a surge from there. But between now and then, expect some volatility and some consolidation thereafter.
Well, I think critically, too, in the second half of this year, what the corporate earnings tell us, and in particular their guidance going into next year, is going to be absolutely critical, right?
I'd expect the kitchen sink to be thrown out. They've been given license in light of what's happened with inflation to do so. But look, last quarter was sneaky good. We had 75% of the companies actually beat expectations. So I'm not expecting gangbuster earnings, but I think they're going to be meaningfully better or less bad, if you will, than people are fearing. So yes, brace for more volatility, but all's not lost here. I think there'll be a lot of opportunity with a lot of the dislocation between now and the midterms.
Very quickly, of the things that you might be tempted to dip into, those companies that boost agriculture yields, because as you point out, food insecurity is a big issue around the world.
That's right. If there's anything this war has taught us as far as Russia and Ukraine is concerned is not only should we not be beholden to our enemies for energy, we can't be beholden to them as far as our food security is concerned. So getting clean water to polluted areas, creating vertical farms so that you could have food, feed a population that was sorely underserved even prior to the war in Ukraine. So yes, companies that boost the agricultural yield, food and ag stocks thematically look very attractive here.
All right. Well, we finish on an up note a little bit there. Jason Katz, great stuff as always. Jason, thank you very much.